Welcome back to the deep dive. If you're tracking global manufacturing, well, you know the name of the game right now is juggling these big geopolitical shifts
Hmm.
while also trying to feed this really hungry domestic premium market. It's a tricky balance.
It really is. And when a company gets it right, the results can be pretty explosive.
It's kind of the ultimate test, isn't it, for, operational resilience?
Exactly. We're seeing companies fundamentally changing how they make things, trying to jump on that whole China Plus trend.
Right.
But they still have to fight against, huge tariffs in some of their biggest export markets. It's tough.
That's exactly why we wanted to crack open the latest data for Carysil Ltd. They're a big name in premium kitchen stuff.
Yeah, sinks, appliances.
We've gone through their unaudited financial results, both standalone and consolidated, for Q2 and the first half of FY26.
And those results just got approved by their board November 10th, 2025. So very current data.
Right. And our mission for you today is pretty simple.
Hmm.
We want to cut through all the jargon and pull out three main things. First, what's really driving this performance they're calling historical?
Second, the sheer size of their expansion plans. They're building a lot.
And third, how are they actually managing these huge global risks, especially those, persistent U.S. trade tariffs we mentioned? What's the playbook?
Okay, let's jump right into the numbers then, because the top line stuff is quite striking, especially given everything going on.
It really is. The consolidated financial snapshot, genuinely impressive.
Yeah, so for the second quarter, Q2 FY26, their total income hit 244.0 crores.
And just for context, that's nearly an 18% jump, 17.9% year over year.
And for the whole first half of the fiscal year, H1, they're already at Rs 471.3 crores. So that's showing really consistent momentum, 15.2% growth there.
Okay, solid revenue growth, that's one thing. But the profitability, the efficiency here, that seems like the real story.
Absolutely. Their Q2 operating profit, the EBITDA, it surged to Rs 49.5 crores. That's a massive 33.5% jump compared to last year.
Wow.
And the margin that comes out of that, that's the bit that makes you look twice.
Yeah.
Their EBITDA margin hit 20.3% in Q2. Now, that's not just good for a manufacturing company. It's exceptional, especially in this competitive global space. And interestingly, the management even pointed out it was higher than the top end of their own internal guidance.
Okay, hold on. Hitting margins above guidance while dealing with a major market, the U.S. slapping on huge tariffs.
50% tariffs, yeah.
How is that sustainable? I mean, are they just burning through old, cheaper inventory, or is this a real fundamental operational game they can replicate?
That's the million-dollar question, right?
Yeah.
But the analysis, it really points towards operational efficiency being the key driver.
Okay.
They specifically mentioned that the U.S. market was dealing with that 50% tariff hit during this exact period. So to pull off these numbers,
Yeah.
they must have either seriously tightened their costs or shifted their product mix towards higher margin stuff, or more likely a bit of both.
And they seem pretty confident about it.
Very. They're sticking to their long-term guidance, 15% annual growth for the next 3-4 years, and keeping that margin target steady between 18% and 20%. Okay, that level of confidence has to be rooted somewhere specific, and I think this is where it gets really interesting. The core engine, the sinks, absolutely. This performance is largely built on the back of their two main sink segments, quartz and stainless steel. Both have shown really strong momentum for, 5 quarters running now?
Yeah, 5 consecutive quarters. The quartz segment especially seems to be running flat out.
Totally. Q2 volumes were just under 200,000 units, 197.6 thousand to be exact. That's up 23.6% year over year.
And the crucial part, capacity utilization, it was nearly maxed out, right? Peaked at 88% in Q2.
Yeah, around 82% for the first half overall. When your factory's running that hot, you don't have a choice. You have to think about expansion.
And speaking of expansion, that's where the IKEA factor comes in. This wasn't just like a small side order.
No, this was huge. They secured the RFQ, the request for quotation, to supply roughly 70% of IKEA's global quartz sink business, excluded the U.S. market.
70% of IKEA's non-U.S. quartz business. That's
Yeah.
massive.
It's a game changer. It basically de-risks a huge chunk of their volume. It says Carysil's quality, their scale, their whole supply chain setup. It meets the super high standards of one of the world's biggest retailers.
Right. It cements them as a major player benefiting from this whole global shift away from putting all your eggs in one sourcing basket,
Exactly. And that's why they can't afford to wait. They need more capacity, like yesterday.
So they're immediately adding 100,000 units of quartz capacity, existing facilities, right?
Yep, at existing facilities.
Hmm.
And the capex is surprisingly low, just 5 crores,
Wow. And that's coming online soon.
expected by December 2025. So very quick turnaround.
And they're already lining up the next expansion, too.
Yeah, the sources indicate they have plans ready for another 150,000 units.
Yeah.
But that seems to be pending some kind of resolution on the U.S. tariff situation.
Okay, so they're building a buffer, basically, ready to hit go on grabbing even more global market share once the tariff clouds clear a bit.
That seems to be the strategy. Now, if we shift over to stainless steel sinks,
Right, the SS sinks. Smaller segment, but running incredibly efficiently. Utilization was around 95%.
95% in both Q2 and H1. They literally had to add a third shift just to keep up with orders.
That's running lean. And their focus here is different, isn't it? Not just any stainless steel sinks.
Exactly. They're specifically targeting the high-value added, handmade stainless steel sinks, not the cheap commodity stuff you see everywhere. These have better margins.
Makes sense. So to meet that demand, they're adding capacity there, too.
Yep, adding 70,000 units capacity right now. That should be up and running by Q4 FY26, bringing their total SS capacity up to 250,000 units.
And they're thinking even further ahead for stainless steel as well. They bought land.
They did. About 7,400 square meters in Bhavnagar, cost them 6 crores, and that's specifically earmarked for future stainless steel expansion.
Future meaning?
The plan seems to be another 150,000 units capacity, probably coming online in the next fiscal year, FY26-27.
Okay, so this isn't just reactive. It's structured, phased expansion across the board. They're placing some serious bets.
Very calculated bets on dominating the premium end of the market, both in quartz and stainless steel, for the long haul.
Okay, it's clear the zinc business is the global workhorse right now. But hitting that 15% long-term growth target, they can't just rely on exports, can they?
No, definitely not.
So how are they pivoting to capture the premium kitchen trend here in India, right, the domestic market? That pivot really comes through diversifying into two other key areas, built-in appliances and faucets. Ah, the smart kitchen trend.
Exactly. Rapid urbanization, rising incomes. It's making the built-in appliance category a huge potential growth driver right here in India.
And the numbers show it's already happening.
Yeah, Q2 FY26 volumes in appliances grew a very healthy 25.5% year over year.
So to grab a bigger piece of that pie, they're investing in manufacturing here.
They are. A significant investment, actually, 25 crores to set up a new assembly line specifically for appliances.
And the interesting bit here is the integrated glass processing plant they're building alongside it. Why is that such a big deal?
Well, think about the look of premium appliances. Hobs, hoods, ovens. That sleek glass finish is key to the aesthetic appeal, right?
Absolutely.
Bringing glass processing in-house gives them much tighter control over quality, over the look and feel. It reduces reliance on outside suppliers, cuts down potential issues. It's a smart move for that premium positioning.
And this adds significant capacity.
It adds 50,000 units capacity per year, bringing their total appliance capacity up to 150,000 units annually. That's expected to start operations in Q1 of FY27.
Okay. And what about the faucet division? How's that performing?
It's doing well. Already running pretty efficiently, around 75% utilization. They're making about 37,500 units out of an installed capacity of 50,000.
And connecting this back globally, there's a strategic angle here too, isn't there?
There is. Their faucet strategy seems laser-focused on future-proofing exports. They're really emphasizing stainless steel 304 faucets.
Okay. Why 304 specifically?
Because it's rust-free and critically lead-free. This isn't just about quality, it's about compliance.
Ah, regulations.
Exactly. The U.S. market is already like 90% stainless steel faucets. But the big shift coming is in the European Union. They're expected to basically mandate a move away from non-brass faucets, probably around 2028, because of changing health and environmental norms.
So Carysil is building the compliant product now, anticipating that global shift. It's like getting ahead of the curve.
Precisely. They're positioning themselves today as the go-to supplier for major global brands when those regulations inevitably hit. It's a long-term play.
Makes sense. And they plan to ramp up production soon.
Yeah, the plan is to activate their full installed faucet capacity, 100,000 units in the next financial year, ready to meet that expected demand wave.
Okay, let's zoom out a bit and look at where they're actually selling all this stuff. The consolidated revenue mix for the first half. India's the biggest.
Yeah, India leads the pack at 34.2%, then comes the USA at 25.6%, and the UK at 18.8%. It's a genuinely diverse geographical footprint.
And within that U.S. market, despite the tariffs, things are actually looking up for their subsidiary.
That's a real success story. Carysil USA Inc., their U.S. arm, managed a significant turnaround. They actually turned PAT positive, profit after tax positive, in Q2 FY26.
From a loss previously.
Yeah, their EBITDA swung from a loss of about Rs 10 lakh last year to a gain of Rs 4.3 crores this Q2. That's incredibly hard to do, especially under a 50% tariff shadow.
Okay, let's push on those tariffs again. A 50% tariff sounds like it could cripple a business. How are they managing to thrive? What's the secret sauce in their mitigation strategy?
Well, part of it is strategic exposure. They've managed it so that only about 12% to 13% of their total consolidated revenue is actually directly hit by those 50% tariffs.
Okay, so it's not their entire U.S. business getting slammed.
Right. And then there's this concept they mentioned, shared sacrifice. It's not just Carousel absorbing the entire cost.
How does that work in practice?
It means the hit to the margin is distributed. Carousel takes a bit, their distributors take a bit, and even the end customer might see a slight price adjustment. It spreads the pain.
Ah, so it keeps their pricing relatively competitive against other imports, maintains volume.
Exactly. And crucially, it preserves those important relationships with distributors and customers. It shows resilience.
That's clever. It's like financial diplomacy. Now, what about their services business? That's about a quarter of their revenue, right? Why is that part largely safe from these manufacturing tariffs?
It's down to the business model. Their U.S. entity, United Granite LLC, isn't really a manufacturer in the traditional sense. It's a fabricator,
Meaning?
meaning they import large slabs of hard surfaces, quartz, granite, marble from all over the world. Then locally, in the U.S., they cut, finish, and install them for countertops, etc.
Ah, so the value add, the manufacturing part, happens stateside after import.
Precisely. And tariffs are usually slapped on imported finished goods. The fabrication model gives them a structural shield against those specific types of tariffs.
Smart. And they're looking to replicate that model elsewhere.
Seems like it. The UK market, for instance, traditionally prefers softer surfaces. But globally, hard surfaces dominate, like 90% of the market.
Right.
So Carousel is planning to diversify into hard surface fabrication in the UK too, aiming to drive future growth there by basically copying their successful US playbook.
Okay, that covers the global picture and the tariff navigation. Let's bring it back home to India and their strategic roadmap here. They have a big domestic target in mind.
A huge one. They're actually putting together what they call a vision document with the explicit goal of growing the India business to Rs 500 crore.
500 crores just from India. That's ambitious.
It's very aggressive.
Yeah.
It clearly signals they see the Indian domestic market as their next major engine for growth and scale.
And they're putting the pieces in place to actually achieve that.
Seems so. They're onboarding new leadership, like a new VP of sales focused on B2B and their premium Sternhagen brand. They're building out their sales and marketing teams and expanding their physical presence. The plan is to add about 10% more dealers every year and open these big new experience centers in key cities like Delhi and Hyderabad.
So it's a multi-pronged attack on the Indian market.
Absolutely. And this whole strategy, both domestic and global, it just radiates confidence.
Yeah.
They clearly feel they're benefiting from that China Plus trend.
Yeah.
And that major global brands are increasingly seeing them as a reliable, high-quality, sustainable supplier. That's driving real interest.
And the fact they're maintaining their financial guidance despite all the macroeconomic headwinds.
Right. It suggests they fully expect these big capital investments and their operational efficiencies to pay off directly on the bottom line consistently.
Okay, so let's wrap this up for you, the listener. What are the key takeaways here? We've seen Carysil hit historical highs, really powered by that explosive quartz sink demand, especially with the huge IKEA deal.
They're committed to immediate, significant capacity expansion across sinks, appliances, and faucets. They've managed a tricky UF turnaround despite those heavy tariffs.
Right, using that shared sacrifice model and focusing on fabrication for surfaces.
And strategically, they're building their portfolio for the future, high-value stainless steel, anticipating EU regulations, and premium appliances for the Indian market.
So the company's making some big bets right now, betting heavily on the premium modular kitchen trend continuing globally and on that inevitable regulatory shift towards stainless steel, particularly in faucets.
Yeah, they're pouring capital into expansion based on these incredibly high utilization rates they're already seeing. So the final thought, the question for you to mull over is this. Given their momentum and these expansion plans, what's the next big catalyst?
Correct.
Which external factor unlocks the next major wave of investment and growth? Will it be a positive resolution, or at least mitigation, of those 50% U.S. tariffs, suddenly making a huge chunk of their business more profitable?
Or will it be the rapid, successful acceleration towards that ambitious Rs 500 core India domestic business goal, proving that engine can fire on all cylinders?
Which one of those milestones, if hit first, really catapults Carysil into a completely new league? What strategic event should you be watching for over the next year or so?
It's a powerful question to consider as global trade and domestic markets keep evolving. Thank you for joining us for this deep dive.